Hello, everybody. So today I have a very simple video where I want to discuss SoFi and kind of the events of the past 2 days. If you look at the stock, you may remember 2 days ago, the stock was up 20%, more than 20%, actually, up to 23% at one point. And everything was doing great, and the market was all excited. And of course, in pure SoFi fashion, it went back down twice in a row. And if actually you look at today, like right now, it's only up 1% from before the earnings, only up 1%. So all of the gains have been erased, as is usual for SoFi. And really, the quote over the long term, the market is a weighing machine applies to SoFi. SoFi is not going to move over short term. As long as we have this crazy environment, as long as we have this nonsense with the Fed still bluffing, as long as that is going on, I don't think SoFi is going to lose that association with speculative stock. It's being dismissed. But eventually this stock will not be dismissed anymore by traditional finance and will not be dismissed anymore as, say, a SPAC type or SPAC like investment, right? It will gain the legitimacy that it deserves, I believe, because when you look at the guidance and when you look at the stock, they are doing a lot of things well. And I just want to look at the numbers and do something very, very simple with the numbers to try to estimate how soon could we get a 2x? And remember, a 2x is an outstanding return. Like if you follow Cathie Wood, for example, Cathie Wood is aiming for a 2x in 5 years on average. She aims for a 2x in 5 years on average, right? If you do a 2x in 5 years, over 10 years, that's a 4x. That's considered an outstanding return. It's important to realize that we have this selection bias when we live on Twitter and we live on YouTube and we see people talking about making 10x, 5x, 2x. That's an anomaly. That's not the normal way that stocks work. If you do a 2x in 3 years, that's an outstanding return. And that's what I want to show you how I get to about a 2x in 3 years for SoFi. So as of January 2023, today is January 31. It will be published tomorrow, so February 1 tomorrow. The market is trading, not the market, the stock, SoFi, the market is having SoFi trade at 2.81 times sales. 2.81 times sales. That's the price to sales ratio. And the price to sales ratio, you can see it's been generally flat for the past year and a half, roughly, and it's been actually declining from the moment that they went public. So flat and declining initially. So I'm just going to assume simply that the revenue is going to increase, but the price to sales ratio, right, is going to stay the same. And I've done that in prior videos. And usually it seems like an overly simplistic way to value a stock, but keep in mind if a price to sales prediction ratio, if that ratio stays the same, but the sales increase, then the price of the stock should go up. But if you were to do the same calculation with a P ratio, you would come up with much starker returns than you do with a price to sales ratio. Because typically, when a company becomes profitable, as is the case for SoFi, the sales will increase at a given pace, and the earnings will increase at a much stronger pace. Typically, earnings at the beginning increase exponentially. So if you were to do this analysis on a P basis, you might even get a much greater number. I think price to sales is the more conservative way to do it. So what would happen for SoFi if revenue were to increase? Well, that's where the outlook comes in. That's where the guidance comes in, because we're lucky to have guidance. And this was celebrated on Twitter for about 2 hours until the market started getting negative again. But we have amazing guidance. So from the conference call, the guidance is clear. They're going to be prudent in 2023, extremely conservative in 2023. And so they're not going to issue that many loans. Keep in mind, they could decide to issue a lot of loans. They're not going to do that. They said 95%. I'm always taking the higher number for SoFi because they're the king of sandbag, just so you know. That's why I picked 95%. I realize they say 92 to 95, but they're going to land 95% of what they lent in 2023. So 95% of the revenue for lending is going to be in 2024. And then this was the shocker: 50% growth in revenue for the tech platform and for financial services. In addition, and this is important to realize, that the number of members are either strategic variable, right? The true marketing variable, the true measure of success, how many people actually register for the service and have not spent much money yet with SoFi or done much banking with SoFi, but they like the idea and so they register with SoFi. That is still predicted to grow 30% year over year. The customers that you recruit over the next 12 months are going to be creating the revenues of the next few years. So anyways, let's go through the metric. So lending at the end of 2023, that was 1.3 billion, and tech and financial services, that was 788 million, right? And we're going to apply these numbers. So they said next year 95% of lending. So that means full year of 2024, you have 1.26 billion, right? And then 50%. So 50% for tech and finance. So 50%, that means you would get 1.1 billion, almost 1.2 billion here of tech and finance revenue. So interestingly, because they're slowing down on lending, you're almost going to get an equal part business lending and equal part technology services and financial services. So that's a 2.4 billion if you add it up, compared to 2.1 billion in full year 2023. So that means they've guided in 2024 for only, quote unquote, only 15% revenue growth. That's what they've got it. And you can see why, because they were very conservative, and they've said it on the call. They were very conservative. I wonder if that has to do with a little bit of a drop. They've guided for 15%. Analysts, by the way, still expect 22%, but that might come down as analysts inevitably update their numbers. That might come down, but I still think this is sandbag. We have enough history of SoFi to know that they always beat. And if they always beat, that means that this is likely sandbagged, in my view. But here's what they've also guided for, and this is kind of the big trade-off in banking. They've guided for a 30% EBITDA margin. That's their target for 2024. And this is what they say, right? They want to manage the overall business to reach 30% incremental EBITDA, right? And that's what they'll do. They'll issue loans up to that point, and that's the limit to the growth. Because in terms of opportunity, right? If they didn't want to hold themselves to the 30% EBITDA, they could grow much faster. They could grow revenue much faster, because keep in mind that banks are essentially money resellers, and a bank that doesn't have good lending practices can end up growing revenue really, really, really fast because they're making a bunch of bad loans. Those bad loans could be issued in the form of loans with low interest rates where you make next to no money, or even worse, you could be making loans to people who are less credit worthy, and you could expose yourself to blowing up the bank. Essentially, banks as money resellers, they can almost dictate their revenue growth, because I guarantee you, if a bank like SoFi started to say we're going to do personal loan at 7.99 and everybody qualifies for 7.99 APY, they're going to make no money, and then they're going to have tremendous amounts of revenue. So the lending segment, they have a lot of say as to how much they want to grow revenue through the lending segment, right? The growth in the number of members, that's much more organic. And if you know my thesis in buying SoFi, it's mostly an organic growth thesis. I honestly don't really care as much about the growth, the lending portfolio right now, as of now. To me, this is a long-term hold. And all of the stocks that I own, by the way, are long-term holds. I really believe in the mantra, right? You shouldn't own a stock for 5 minutes if you're not going to own it for 10 years. I really take this to heart. To me, this is a product adoption story. I will ride this stock until it is a top 10 financial institution in the US, which is the long-term goal of a company like SoFi. Anyways, all of this to say, I bring up 30% EBITDA margin to say that I think a better way to assess SoFi is to use the rule of 40, right, that they have in SaaS stocks. And if you've been following my channel, I've been implementing, quote unquote, the rule more and more often to assess whether a stock is good or not. And in the case of SoFi, you have 30% EBITDA margin and 15% growth, with they just guided, which gives you a rule of 45, which is above rule of 40, which is typically considered the gold standard for growth company, historically SaaS companies. But I believe this metric of adding profits to growth works really, really well for all sorts of stocks. And that's above my 30% threshold. My goal on this channel is to achieve 30% growth every year in the portfolio with a good help from the denominator and the devaluation of the US dollar, right? That's part of the other thesis. When people say, oh, 30% is not possible, that's because they don't take into account my expectations for the devaluation of the dollar and the US dollar and inflation. So that's a nominal number. That's a nominal goal, not a real goal. And I would agree that if you think in real terms, 30% is next to impossible to achieve in real terms. I would mostly agree with that, but not in nominal terms. In nominal terms, I think it's possible, and I've been very darn close to that. I bought a lot of stocks very early on. I've never calculated it, but I'm very happy with the way it's doing. This is a long journey for me. I've been doing this for 13, 14 years. This is a long journey. So, anyways, the point is, this channel is to share the passion, by the way, with my viewers here, and I'm so grateful for all of you, by the way, sharing this passion. Anyways, quickly, let's talk about the long term for SoFi. The SoFi long-term guide. We have the guide. So from 2023 through 2026 time period, they expect between 20 and 25% annual compound annual revenue growth. Now, we know that SoFi is the sandbag king. So as the sandbag king, I'm going to give them 25%. I'm gonna read this as 25%. And we know that we already have 2023. So 2023 is already in the books. That was $2.1 billion in sales. So 2.1 billion in 2023, 2.65 2024, 3.3 2025, and 4.1 2026. If you assume that the price to sales ratio stays the same the whole way, that means you would move from a market cap of 7-ish billion to almost 12 billion, and that's exactly a 56% in 3 years. Now, that's a crazy assumption to think that price to sell is going to stay at 2.8, especially as the profits get ramped up, and especially as the low interest rate environment comes back down and loans get picked up, right? If the interest rate environment goes back down, companies are going to lend more, banks are going to lend more. This is going to reaccelerate the growth. So to me, this back of the napkin number of plus 56% is really, really the rock bottom return that I imagine on this stock in a 3-year period. To me, it's closer into a 2x if you take into account the eventual re-rating of a price to sales. Two-bagger in a bit of 3 years. It's kind of my working assumption of this. And by the way, I just want to say this, it's well above the NASDAQ. The NASDAQ is considered, right, you should not compare returns to the S&P 500 because the S&P 500 is not representative of real returns in my view. There's many flaws in looking at the S&P 500, but I think the NASDAQ is a very good benchmark. And if you're an individual investor, you should try to beat the NASDAQ. Is kind of what I think. And 56%, by the way, you beat the NASDAQ at 56%. You definitely beat the NASDAQ with a two-bagger in 3 years. If you did 100% in 3 years, you definitely beat the NASDAQ. So to me, this stock fits very, very well in my portfolio. It's a top 10 position. For me, it's a large position. It's a meaningful position. If it goes to zero, this position would hurt. I have a credible commitment to this position, even though I obviously do not cover it nearly as much as many popular YouTubers who have specialized in covering SoFi. And I love that we have so much good content on SoFi. But anyways, that's my worst case scenario, a 2x, and in 3 years. And that obviously that's no financial advice, no investment advice at all. This is just entertainment. Please like, please subscribe. Thank you for watching and have a wonderful day.